Good morning, FinMonkeys listeners. I'm Noah Mercer, and welcome to the FinMonkeys Morning Brief. Today, we're zeroing in on the Fed's new chair, Kevin Warsh, and how his fresh communication style is already nudging the markets. Stick around. There's a lot to unpack about what this means for rates, yields, and your portfolio. First up, the Wall Street Journal reports that Kevin Warsh is overhauling the Fed's language, leaving investors to read between the lines. That matters because a shift in tone can spark volatility as markets scramble for clues. Next, according to KWXX, Warsh left the benchmark interest rate unchanged in his first major policy move. Keeping rates steady means borrowing costs stay predictable, giving the economy a bit of breathing room. So what's actually framing the day? Warsh's pivot to a softer, more flexible narrative is already shaping how traders react. By dialing back the usual crisp guidance, he's giving himself room to maneuver, but that also means investors have to read more into the subtext. Meanwhile, the decision to keep rates flat reinforces the Fed's stance that the economy isn't overheating, which keeps mortgage and corporate borrowing costs stable. The mix of cautious language and unchanged rates is creating looking ahead, the bond market is feeling the ripple effects. NPR reported that even with rates unchanged, the Fed officials hinted a tightening could be on the horizon, suggesting a possible rate hike later this year. CNBC observed mixed movements in Treasury yields as investors process Warsh's guidance, reflecting uncertainty about the Fed's path forward. And the Las Vegas Review-Journal noted that, despite the restrained public messaging, many of the Fed officials still favor raising rates. That's the FinMonkeys Morning Brief for today. The next thing to watch is Fed statements, and Treasury yield shifts will signal the next direction. Thanks for listening to FinMonkeys. We'll be back tomorrow with the next market setup.